Welcome to this Killik Explains finance video. This week, how small investors can beat much bigger ones. We get used to the idea, as smaller investors, that the market is dominated by big institutional investors, and it is, in volume terms, but there are ways that small investors can steal certain advantages and play the fact the market is dominated by lots of people who sort of do the same sort of stuff to their own advantage. Now, the background therefore is what? Large institutional investors do tend to dominate financial markets. It is the money being deployed by pension funds, life assurance companies, big funds, that tends to dominate the way markets behave. They bill themselves as bright, connected experts. So they are the experts. That is why an awful lot of people hand money over to them who don't have the knowledge, the time or the interest to do it themselves. But they also carry some quite unhelpful baggage. Now, what do I mean by that? What I mean is they've got like one hand behind their back some of the time because of the way they tend to operate as a group of investors. Now, being a big fish has its challenges, hence the title here. So what are they? Let's take a look at, first of all, short-termism. These are people under an obligation to hit targets, and much as though I try and reinforce the benefits of taking a long-term view, some of these institutional investors, in reality, are incentivized to take a shorter one. Then there's groupthink, running with the herd, more about that coming up, and then there's hubris, getting basically too big, literally and metaphorically, for your own boots. Now, short-termism, what is that? Big investors have regular short-term targets to hit, quarterly reviews, half-annual reviews, annual reviews, and so on. So they are incentivized, despite what they might say, to hit certain short to medium term targets. There's career risk for not doing so if you plan to move on to another bigger, better known fund, for example. They find it hard to do nothing, therefore. Now that's something that I recommend quite often to people who are anxious, or they haven't traded for a while, haven't done something. Sometimes doing nothing is exactly the right approach, rather than churning to generate activity that turns out to be of no benefit or value to you in the long term. They often chase performance on top. So, a new exciting story emerges, whether it be unicorns, that's the group of stocks coming to market at the moment that are app-based, Silicon Valley and so on. They tend to chase new stories. They're worried if they don't, that they might miss out, and if they miss out, they find themselves in that dreaded bottom quartile. So groupthink, and these are all interconnected. This is the idea that big investors do fear that bottom quartile or bottom decile, so they'll avoid it at all costs. And in order to do that, they tend to be fairly benchmark obsessed. Indeed, certain funds that bill themselves as active are not 100% active. Quite a bit of the money they run is in what they perceive as safe, benchmark hugging homes, and they might be active with a certain proportion of the fund, the tail as it's known. And that tends to create herding. It tends to create investors who have to chase down the same ideas. For example, if you're looking for income stocks, you'll find an awful lot of the income funds in the market are not as stratified as you might think they are, because they're all holding fairly sizable positions in a fairly small group of income-paying stocks. And contrarian thinking is therefore pretty rare. So whilst all the books say you should be greedy whilst others are fearful, fearful whilst others are greedy, because of career risk and groupthink, quite often the biggest investors in the market are actually not really following anything that could be identified as a contrarian viewpoint. And thirdly, hubris. All right, once you've been praised for being top quartile for long enough, overconfidence can set in, and that's certainly a risk with big funds. Big investors tend to start blurring skill, alpha, with pure luck. All right, they can get a bit complacent as money rushes in, supports their original investment strategy. They start to get more anxious about how they're going to replicate past performance, perhaps start diverging, it's called style risk, with funds away from their original mandate, simply because it's difficult to maintain the original mandate and the performance behind it for a long period of time. Past success can also breed complacency. Well, I've been top of my game for the last 4, 5, 6, 7 years. Frankly, it must mean I am, in fact, the best at what I do. Not necessarily the case. And big can then be confused with beautiful. People tend to think, look at the assets under management. This must be one of the best players in the market. It is one of the bigger players in the market, but not necessarily the best. Small investors, therefore, what does all this mean? If you're a smaller investor, how does this help you? Well, frankly, you just avoid those 3 challenges, if that makes sense. So as a small investor, ignore the Joneses and stick to your personal objectives and timeframes. In other words, don't chase performance, don't herd, don't pile into unicorns just because they're splashed all over the pages of the media. All right? Think about what you're doing, stick to your objectives-led personal strategy. Avoid hyperactivity and performance chasing. In other words, don't buy and sell, move money around in your portfolio simply because you've read something or been urged to do it by, for example, a media headline. Better to work out how often you're going to review your asset allocation and then do it systematically rather than on the hoof. And then thirdly, turn off your app and be patient. The problem with digital solutions to investing, brilliant though they can be in many ways, cheap though they can be, is there is a button right there, and if you push it, you buy, push it again, you potentially sell. It's all too easy, all right? And it's sometimes counterproductive. So be prepared to take a long-term view. Don't get encouraged by the fact you can trade easily into trading too quickly and too easily and too frequently, and stick, as I mentioned it, to your longer-term strategy. And bear in mind that if the bigger investors in the market can't be contrarians, sometimes for the smaller players that opens up the possibility that they can be. Editor at Killik.com with questions, and if you want to watch videos that explore some of the ideas I've mentioned in a bit more detail, including those unicorns, then it's Killik.com/learn, and over here go for the shares tab.